What's up you guys, welcome back to the channel. Today we're going to see the difference between lump sum and dollar cost averaging in terms of investments. We'll jump into an interview with someone that worked into the financial industry for more than 20 years. He's going to explain us the difference between the two and also why you should use one and not the other. We'll also speak about risk management, so stay tuned. So what is lump sum investing? Lump sum investing is when you use a big amount of money, a huge amount of money that you just dump at once. This can happen because maybe you have a lot of savings and now you want to start investing, or maybe you won the jackpot at the lottery and you just invest all this money at once and watch it grow. Dollar cost averaging, on the other hand, is when you put your money in the market consistently. So for example, myself, I do dollar cost averaging every single month. But when you never invested and you want to know if it's better or not to just dump all your money at once or do it over a period of time, this is hard to know. And also you have to keep in mind that putting all your money at once may be more risky than putting it over a period of time. So right now we're going to jump into an interview with someone that worked into the financial industry for more than 20 years, and he's going to explain to us what you should do. So right now we're joined by KD Leifert. He's the person behind the CrossFit Pilots YouTube channel. And welcome, Kai.
Hi everyone, nice to be here. Thanks Alexi, excited to be on your channel.
Well, I'm happy to have you here too. So to start this interview, can you just maybe present yourself, tell us what you did in the past, and maybe speak a little bit about your YouTube channel?
Yeah, of course. I'm quite excited about my career as such because I've spent about 20 years or so in the financial industry. I started off in risk management, actually, in the asset management sector. And I've done that for quite a while, became a chief operating officer for another large financial institution. But then also realized that there are a lot of people who have constraints in their head and who maybe not live up to their full potential. And so I wanted to do two things. One is what I'm doing with this YouTube channel to help bringing some of the business knowledge that I have and some of the leadership advice and some of the things that I've learned over the years in how to obtain your freedom. And actually, that's all what Alexi's channel is also about, to bring that to viewers. And then the second thing is I already had a private pilot's license and I wanted to expand a little bit on that. So a couple of years later, I also qualified as a commercial pilot, and to some extent, I'm still working on that today.
Well, that's great. And you're doing a lot of great content on your channel, and actually the link will be in the description of this video. So if you want to go and check out his channel, the link will be just right below. So you said that you worked in the financial sector for a bit more than 20 years, is it right?
Yeah, well over 20 years. Makes me feel old.
So you probably have a better knowledge about risk management than I do.
It's quite funny. When I joined the financial industry, at least in the asset management sector, there wasn't much talk about risk management. When I came to approach one of the directors of what ended up to be my first job, he didn't really know much about risk management, and he was very clear. And he said, actually, we don't really need that. But turns out that a couple of months later, he changed his mind, luckily for me.
Yeah. Yeah, that's lucky, because if you don't manage your risk enough, that can be a problem.
Pretty much.
So let's start into speaking a bit about investing your money, about lump sum and dollar cost averaging. So in your opinion, what would be the best way to invest your money between the two kinds of investments that I just mentioned, and why?
It's actually a question I've been asked quite a few times, and maybe the initial answer is a little bit unsatisfying because I'll have to tell you it depends.
That's right.
I think, and this is where the risk management part comes into it a little bit. The primary question you ask yourself is, what is it what we are trying to achieve? And that is also the main question to ask yourself. Is it better to invest in a lump sum, or is it better to invest over time in small amounts? Now, what I've seen and what many studies have shown is that if you compare the two investments over time, you are almost always a little bit better off if you invest your money over time and if you cost average over a period of time. And it's something that I think, especially when you start investing and when you have to be very conscious about what you want to do with your money and you can't risk a large amount of money, it's a great way to start. And it is also proven to actually achieve better returns than in some other ways.
Yeah, and especially when the market is doing like it's doing right now, like a downturn, you don't want to put all your money in the market and just maybe lose like I did in my portfolio. At first I did like minus 30% because of the whole crisis that we're having. But my strategy is not to lump sum, it's actually to dollar cost average. So over the time, when the market is doing a bit of sort of a crash, it's actually better to do dollar cost averaging because you are buying more shares with the same amount of money that you should be investing every month.
Yeah, very much so. I think the current climate and the current crisis shows something else as well. I was approached by a couple of people quite imminently after the crisis, and as you say, after the stock markets dropped 20, 30, in some markets 40%. And they asked me, okay, so what shall we do now? And my response to that was, well, again, first of all, it depends what do you try to achieve. But if you are in it for the long term, again, even in this situation, I wouldn't put all my money into the market. I can share with you, me personally, when the markets came down, I had a little bit of money sitting on the sidelines.
So you had a lot of cash on the side ready to start investing?
Yeah, there was, you invest over time, but because the markets were quite saturated and they were quite high at the time, I over time also built up a little bit of cash on the side. And what I personally decided to do, and that was also the advice I gave to the others, was to actually take 50% of that money and invest it in the stock market. And that gives me some options. So first of all, and some experts say that's probably still the case, if we see another drop of maybe another 10-15%, it allows you to buy in even cheaper. But at the same time, if that doesn't happen, you are invested in the market. And then, as Alexis, you say, you can month by month invest a little bit more. And so you average up, but you build up your portfolio that way.
Yeah, and let's talk a little bit more about risk management and about emotions, because a lot of the time, especially in the stock market and about money, people are really attached to the money. And people feel emotions when they see the price of their investment going down or the price of the investment going up also. So in your opinion, is it better to dollar cost average your money if you're anxious about how your investment will turn out?
Sure. You know what? The first thing I'd say is if you're anxious about your money, you shouldn't invest at all.
That's right.
Now, I want to qualify that. I'm not saying you shouldn't invest ever, of course. But if you are a little bit anxious about it, what I would personally say is, first of all, try to get more information. You can read up on newspapers, you can read up on books, you can watch YouTube channels like this one. Because the more you know about what you're about to do, maybe the less anxious you get. The other part that I would also say is, even with the investments that you envisage to have for a long time, maybe even to retirement, make sure that you only invest the portion that you personally feel comfortable to lose. Now, it's very unlikely that you will lose all the money in that investment, but if you are comfortable with that, actually that's the best way to manage those emotions, because I'm absolutely with you. When the stock markets drop 20-30%, people get nervous. And frankly, if you made 5 or 10% on your investment, people also get nervous. And I see a lot of people exiting the market when they actually shouldn't.
Yeah, right. People, when they see the stock going up a lot, they're like, oh, I need to get out right now, because maybe the stock will just crash after that. But what about a dividend investor, someone that is not looking for market return but more in dividend payments? You should never sell a stock, even if the price is way higher than it used to be, because you don't want to make a quick buck out of selling this investment. You want to hold it for the longest you want, for the longest you can also, so you have those dividend payments coming every month.
Yeah, a couple of things I would say to that. Number one is a very basic thing. When you start investing and when you put money into your investment, actually write down the reason why you did it in the first place. Because we tend to forget, we put money into dividend stocks and then the market goes up 20% and we go like, oh, maybe actually we should realize those profits, right? Whereas that actually was never the purpose of why you put the money there in the first place. Mm-hmm. So write down why you are investing, and when you want to sell or when you want to invest more, pull up that piece of paper and read it again, and maybe that already changes your mind. You need to set a very specific goal, what you try to achieve with that investment. That can be very broad. That can be saying, look, at the end of my working life, when I'm 55, when I'm 60 years old, I want to have X amount of money in the pension pool. Or that can be as easy as I want to gain maybe 10-15% in a particular market. But make sure that before you invest, you have that goal. But the other thing I would say is very much related to what you asked about earlier about, is it better to invest a lump sum or is it better to invest in over time as a cost average? And when you particularly ask me about the dividend stocks and the dividend investments, I think those investments are probably more catered towards the lump sum. You put money in and your actual goal is to get a certain amount of dividends every month or every year. And as long as you achieve that, you can leave the money there and don't touch it. And whether it goes up or down wouldn't affect really your goal. When you do have a little bit of money every single month that you are willing to risk, that you can invest, one of the other ways to invest is in growth stocks. And because they tend to move a little bit more than the average market, your dollar cost average comes in a bigger way actually than it would do with dividend stocks.
Right. And actually, you know what? I have a friend that started investing, I think it was like a little bit more than 2 months ago. And he was like, okay, oil in the future, there's gonna be a huge problem with it. There won't be any more oil and the price of it will just explode. So what he did is that he took, I think it was most of his savings, and he just dumped all of it into, I think it was Shell. And guess what happened just after that? The oil crisis. So in just a few days, not even a few days, I think it was in just one day, he lost 30% of his investments. So what would be like an advice for him to minimize his loss? Should he buy right now, now that the stock is going down quite a bit? Or should he wait for it to recover and maybe in the future see some green in his portfolio?
Well, in some shape or form, that part happened to me myself. So I can relate to it, but it comes back to what you mentioned about managing emotions. The stock market isn't for the emotional. And so the first question I'd ask is, what was the goal in the first place? If your friend is convinced that there will be an explosion in oil prices, well, frankly, the current market hasn't changed that as much. Yes, we would see a delay in that because for a number of months we don't see airplanes flying around, we don't see many cars driving around. But fundamentally, we haven't seen suddenly a new technology that replaces oil. So if his analysis was right in the first place, it's still right, but you have to ask yourself, how long can you hold your breath, right? So that's coming back to the emotions. Are you willing and able to stick with your opinions? And the second part is, at the same time, be open that things may have changed, right? If you Warren Buffett is a great example of that. A couple of years ago, he started to get quite large stakes in airline stocks, which just very recently he dumped, right?
Yeah, he sold everything, right?
He sold everything, and it wasn't even because he said, oh, they are really bad. It was because
of the fundamental of the airlines that are going to change in the future.
Absolutely. He said, look, that industry has fundamentally changed, but more importantly, I don't know exactly how it changed. I don't know exactly what it will look like in the future. And Warren Buffett is an investor who only wants to invest in things he fully understands. And that's his rule, that's his goal. And so he took the emotion out of it. He lost a lot of money on those particular airline stocks, but he took the emotion out and said, actually, I put up my hand, I was wrong, industry has changed, let's move on. And that's sometimes what we have to do as investors as well.
Yeah, I think that you should consider changing the way you see your investments if the fundamentals of this kind of sector you're investing in is changing, just like Warren Buffett did. Thank you for all the questions you answered. I think it's really valuable for everyone watching this video. And remember, guys, in the description of this video, you have the link to the Crosswinds Pilot channel, and you can go and say hi to Kai for for him. He will be really happy to have new viewers coming to his channel. And yeah, thank you, Kai, for the interview.
No, thanks, Alexis, for having me on your channel. It's a great channel. Enjoy watching it, and yeah, good luck. And as always, come by, say hi. If you have any further questions, I'll be always happy to join you.
Alright, right now you can go and check out this video on how to start investing for beginners. And if you're new to the channel, if you've never seen me before, well, you should subscribe to the channel and put me a little like. That's always good for me. And I'll see you guys next Saturday for another video. Bye bye.